Good morning, everyone, and welcome to the first ever SentimenTrader guest webinar series. We're thrilled to have you join us for this special event. My name is Dean Christians, and I'm a senior research analyst at SentimenTrader.com. At SentimenTrader, our mission has always been to cut through the noise and provide data-driven, objective insights into market trends, helping investors make more informed decisions. Our research is widely followed by journalists, retail traders, financial advisors, family offices, hedge funds, and even other newsletters, i.e. our competitors. Our guest webinars provide a platform for our subscribers to share their expertise and how they integrate SentimenTrader's research into their investment process. We're honored to welcome Manuel Blay from the Dow Theory newsletter, who's been a subscriber since 2021. Manuel is one of the foremost experts on Dow Theory, a foundational market analysis concept that remains just as relevant today as it was over a century ago. He'll be sharing his deep insights into the Dow Theory framework and how he uses SentimenTrader research to complement his market analysis and investment approach. For those of you who couldn't attend our January webinar, we examined how the U.S. economy and stock market have transitioned from a real economy to a digital economy. I have two charts that visually show this evolution. The first chart shows the S&P 500 sector market capitalization as a percentage of total. Industrials, financials, energy, and materials comprise the real economy, whereas technology, consumer discretionary, and communications represent the digital economy. Notice how the real economy sectors have been making a series of lower highs and lower lows. In contrast, the digital economy has achieved higher lows and higher highs. The second chart shows the S&P 500 has shifted from tangible, asset-heavy, that would be things like buildings and equipment, inventory, land, to intangible or asset light, which includes items like patents, customer data, and software. As of 2020, those intangible assets as a percentage of market cap represented 90% of the S&P 500's total assets. With this evolution in mind, who better have on as our first guest speaker than Manuel, given that Dow Theory relies on two real economy industries, industrials and transports, to evaluate the overall market outlook. Topics of discussion for today are, is Dow Theory still relevant for assessing market trends in an economy that is less influenced by traditional business cycle and interest rates, i.e. the real economy versus the digital economy? And then two, in addition to Dow Theory, which SentimenTrader tools does Manuel find the most useful in his daily market analysis and trading decisions? With that, I'll hand it over to Manuel for some opening remarks. Manuel, welcome, and thank you for joining us.
Hey, thank you for having me on your website. It's a pleasure. Thank you. So, let's get started. First of all, I apologize. I'm really with a sore throat, with a bad cold, and I will try to survive. Okay, so what's the Dow Theory? First of all, is trend following. So we have to know where we are. So I think it's the most effective trend following method to time the market. And what we do at our website, at dowtheory.com, is, well, we time the market successfully with a proven track record by using the Dow Theory and also another indicator, but the Dow Theory is really a cornerstone of our trading approach. So, it has an incredible track record. It was discovered or, well, created by Charles Dow already 130 years ago. So nobody can say that, well, it's maybe a flimsy record. No, it's something really proven to work. So maybe if we go to the next slide, I can show you a little bit more about the Dow Theory. Yeah. So the question Dean suggested was that in an environment where the economy is less prone to recessions, whether the Dow Theory still works. Because, of course, if we don't get a recession, then we will get less bear markets. And when we get a bear market, the drop is going to be less meaningful than when we get a recession. So I have good news. So the slide shows that bear market drawdowns with and without recession. You can see the orange bar shows bear markets when there is no recession, and well, you have a decline of 24%, which means that you can time it. So there are ample opportunities for a market timer, for the Dow Theory, to profit from such drops. So it is not that now, because we don't have so many recessions, we just get a minus 10% drop. No, sometimes it's minus 10% like now, and sometimes it is much more. So we also see the red column that shows that bear markets, when there is a recession, well, there is a plunge of 35%. Of course, when there is a recession, bear markets are more harmful to your portfolio. But that doesn't mean that in the absence of a bear market, you don't have to protect yourself. And if you get a normal bear market without a recession and the average drop is 24%, I think you better time the market, and furthermore, you can profit from it, because as market timers, we need the market to go down to hopefully rebuy at a lower price. So if in the absence of a recession, we only had a drop of 7%, then forget timing. So the issue is, we can see clearly that despite changes in the economic cycle, that the market is less prone to recession, which is undisputable, we still get seizable drawdowns, which provide us with trading opportunities. So maybe we can see the next slide. Well, this is really important piece of statistics. What happens when we get a Dow Theory sell signal? Well, the average decline after the Dow Theory sell signal is a further 11.22% on average. So once again, this confirms that there is more downside, and once again, that you should protect yourself, and furthermore, you should profit from it, because if you sell before the big plunge begins by using the Dow Theory, you will be able to rebuy at a lower price, which is the gist of market timing. We also know that the average duration of the decline is 4 months. Sometimes it's less, sometimes it's much more. And very importantly, the probability of a bear market following a Dow Theory sell signal is 60%. So in other words, you should take Dow Theory sell signals seriously. So this is a larger than average probability to get a bear market. So once you get a Dow Theory sell signal, which happens on average, as you can see on the slide, 22% above the onset of the subsequent drop, 60% of the time, it is followed by a bear market. And what's the probability of a recession? Well, it's 27.5%. So there is a slightly higher than average probability of a recession, which fits with Dean's insight. So in the sense that we don't need a recession to successfully time the markets. Okay, as you can see, even historically, there weren't so many recessions coupled with a Dow Theory sell signal. But despite of this, as I will show you a little bit later, the track record of outperformance and drawdown reduction is really unbelievable. So, and this is something very important. So even historically, we have a low probability of a recession, 27.5%, but that doesn't mean that the drop can be significant enough to result in a seizable decline, which means that for trend followers, there is trading opportunities. So maybe you can see the next slide. Well, the proof of the cake is in the eating. So for instance, here I compared the Dow Industrials in buy and hold mode versus the Dow Theory, starting in 1953 and ending by the end of 24. And you can see a consistent pattern of outperformance and drawdown reduction. You see the Dow Theory makes much more money, in this case 88 millions versus 15 for buy and hold. But more importantly, please bear in mind that this is a log chart, so which doesn't exaggerate our performance, but The difference in performance is huge, 88 million versus 15 million for buy and hold. And furthermore, if you look at the zigzags of the equity curve, you will see that we really do an excellent job of cutting drawdowns. And later in this presentation, I will show you that on average, the Dow Theory cuts drawdowns by 50%. So if you have a market and your deepest drawdown has been, let's say, the S&P, 55% in 2008, then the rule of thumb is that the Dow Theory will cut this maximum drawdown by half. So it is going to be 23, 24, 22%. Later, I will show you one slide. We can see maybe the next slide. So, okay, now comes the question. Okay, you are talking to us the beauties of the Dow Theory. That is great. Okay, but why does it work? Why? Why are you a deep believer in the Dow Theory? Well, first of all, because it has a plus 120 years successful record. So this is not a trend following system that was devised a couple of years ago and it performed well. No. So it has been tested and tried under all kind of market environments. So the track record is important. Furthermore, in our website, our adaptation of the Dow Theory has been traded since 1953 because, well, our service was started by Jack Shanep. And well, now he's 90 years old or 19 years young because he's still extremely clever and smart. And okay, so we have a really also real time track record. So first of all, is the record, but also only relevant pivots matter. What do I mean by that? If you look at the chart on the right side, you will see that I highlighted several pullbacks, drops, and I tick them with a red X, with a red cross, which means that these pullbacks did not qualify as a valid sell point in case it were broken down. So for instance, in this chart that starts, I think, in 2023, something like that, we get three pullbacks that they didn't qualify for a secondary reaction, which is that relevant point to be broken down for a sell signal. And then finally, in January, March this year, 25, then we get the one I ticked with the green, in green, the real one. So you can see here that if we had exited the market in previous pullbacks, then it would have been ill-timed. So this is important. So only relevant pivots matter. The Dow Theory is not a breakout system. You say, okay, I'm going to sell when there is a 20 days low or 50 days low, or I'm gonna buy when it's a 40 days high. No, because this, well, it can marginally add some value, but it has nothing to do with the Dow Theory. By pinpointing the relevant drops that qualify as the relevant pivot to be broken down, we get rid of the noise and we get the signal. Why does it work? And then because for us, for a drop to qualify as a relevant drop, the Dow Theory has the time and extent requirement. What do I mean by that? For instance, we need a minimum of days for the drop. So if we had a huge drop, but it only lasts 5 days, then this is not going to qualify, no matter how big the pullback. So we require a minimum time. In our case, in our Dow Theory flavor, we require the average of the three indexes, the Dow Industrials, Transportation, and the S&P, to have a 8 days average drop on the three indexes. So the time requirement is the first filter to get rid of really non-qualifying drops. But furthermore, there is the extent requirement. What do you mean by that? Well, this is well documented in the Dow Theory. It was already documented in 1933 by Robert Rea, that we need for a movement, be it up or down, to be relevant, we need at least a 3% movement. So if the S&P, for instance, has dropped for 20 days, it would fulfill the time requirement for a relevant pivot. But if it only dropped 2%, then once again, it doesn't qualify as the relevant pivot to be broken down for a sell signal. Furthermore, once you get the time and extent requirements, there is another 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 principle, the principle of confirmation. What do you mean by that? It means, let's imagine, okay, that the S&P has dropped 20 days, it has dropped, I don't know, 20%, whatever. So it really qualifies in itself as a secondary reaction, but neither the Dow Transportation nor the Dow Industrials have dropped by at least 3%. So the principle of confirmation means that the time and extent requirement must be confirmed at least by the Dow Industrials or the Dow Transportation. We always focus on the S&P 500, but at least either the Dow Industrials or the Dow Transportation should confirm. So it means minimum movement, 3%, and at least a day's drop. So when you begin to put all these things together, you start to see that how we get rid of irrelevant pivots, and only the good ones, as shown in the slide. You can see clearly there were 3 of them that were not proper secondary reactions, so they didn't set up for a sell signal. But the final one was the right one, the real one. And finally, another thing that makes the Dow theory really unbelievable is the non-parametric nature. What do I mean by that? I mean that when you trade a moving average or a breakout system, you are bound to parameters. So you say, okay, 200 days moving average or 20 days breakout. But it has been studied that when you make your system dependent on a parameter, it is less reliable when looking forward. And that Dow theory, it doesn't depend. So doesn't depend on parameters. So we are not saying, okay, look, it's going to be the 20 days high or the moving average. No, some pivots qualify and some pivots don't qualify. And sometimes it will be a huge pivot. Sometimes it will be a tinier pivot. It depends. So the non-parametric nature is another factor of stability when looking forward. So maybe we can see the next slide. But it doesn't only finish with the stock market, because Hamilton, which was the chief editor of the Dow, the Wall Street Journal in the 1920s, last century, he had a great insight in his book, the Dow Theory Barometer. He said that he was sure that the Dow theory could also be applied successfully to other markets. And as far as I'm aware, nobody tried. Okay, he said that he was convinced that the Dow theory could be successfully applied to other markets to time them, but he didn't develop that. But I've been developing that since I started with my blog, for the last 15 years in real time. And sorry. Sorry. And Hamilton was right. So what do I mean by that? In my blog, live, real time, I've been seeing what happens when you apply it to the energy complex. You can see the ETF, USO, and the XLE. What happens when you apply it to GDX and SIL, so the precious metal miners ETFs? What happens when you apply it to gold and silver? And what happens when you apply it to TLT and also IEF? You bear in mind that the Dow theory always requires at least 2 assets to indexes to derive signals because of the principle of confirmation. So this is important. So I cannot trade gold or oil without using something that is similar, but not exactly the same as we do with the stock indexes. The Dow Transportation is similar to the S&P because both are US stock market indexes, and roughly they both respond roughly to the same conditions. And this roughly is really important, because we don't want absolute correlation of one. And Dean, which is really extremely good with programming, maths, and statistics, will understand that. So I don't want 2 indexes that are exactly the same. I want them to be relatively similar, but not the same. So for instance, why it works with stocks? Because the Dow Transportation is similar, but not identical to the S&P 500. The same applies when we go to energy, precious metals miners, even treasury bonds. I show TLT because it's the one I trade, but the pair I use is TLT and IEF. So always we need to. So let's look at the slide. You can see that for the Dow Industrials, there is a 50% drawdown reduction. For the energy ETFs, USO, XLE, there is unbelievable, a 90% drawdown reduction. Well, this is the outlier. I wouldn't believe that, but this is what happened when I was blogging for the last 15 years. Then we have for GDX and silver, very similar to the stock market, so a 50% maximum drawdown reduction. For gold and silver, once again, very around 50% reduction. And for TLT, which is the instrument I trade, I don't trade IEF because it has really very low volatility. I use it to derive confirmation, but I only trade TLT. Look, it's a drawdown reduction around 55%. So this is very important, even if you are not going to trade these markets using the Dow Theory, but it should give you comfort and security in the sense that this has been really tested across many markets, and it works because it's a non-parametric. Once again, it's non-parametric, so the principles work in all these markets. So maybe we can go to the next slide now. Well, this slide shows the annual outperformance versus buy and hold. For the Dow Industrials, which is the birthplace of the Dow Theory, is slightly above of 3% per annum. But please bear in mind that this is 3% with a 50% drawdown reduction. So risk adjust is really huge. It's really huge. For USO, for the energy sector, we get an outperformance roughly of 1.5%. Maybe you remember we had a huge drawdown reduction, but outperformance was more mitigated, 1.5%. For GDX and silver ETF miners, we get a huge outperformance of 5%. But of course, I would take all this with a grain of salt. So for me, it just shows that there is outperformance, and the future is not going to be like that. And maybe in the future, GDX is going to perform less, but TLT is going to perform more. But of course, when you have very different markets and you get outperformance in all of them, this tells you a lot that you are really trading with something that is really very solid, very solid. For gold and silver, there is an outperformance around 0.6. So this is, well, as you can see, there are difference for the precious metal miners. There is an outperformance of 5%. For the metals themselves, much muted, but okay. And then for TLT, the US Treasury bond ETF, we get more or less 2.5%. So, okay, the takeaway is clear. So there is a huge drawdown reduction and there is outperformance. So maybe we'll see the next slide. So here you have the rule of thumb. As a rule of thumb, and over long periods of time, the Dow Theory adds 2-3% annual outperformance with a maximum drawdown reduction of 50%. So this is more or less what you can expect. This is what we have been doing on our website for many, many years. This is not only a record, I repeat, because the website was started a long time ago by Jack Shaneb, so we have all the trades there. So it works. So for me, of course, you know that to be a trader, you have to really believe in what you do. If you don't have a deep faith in the trading system you use, then you will you will give up at the worst possible moment. So I really believe, and I hope that I have said why I have such strong belief in the Dow Theory. Okay, next slide. So, SentimenTrader, well, I've been a long-time subscriber. I really think they are really the best guys out there. I have to tell you, look, my time is in short supply, so I don't have time to read emails. So only the relevant emails can get 5 or 10 minutes of my time. And SentimenTrader, they get this 10 or sometimes even 15 or 20 minutes if necessary. So for me, it's really useful because while SentimenTrader, they don't do the actual buy and sell. Well, the TCTM, yes. But for me, well, there are plenty of tools that help me assess where the market is headed. And in particular, for instance, right now we had a 10% drop. So everyone was panicking. I also noticed because I got many emails from subscribers and I felt panic in the air. And then of course, then you have to keep a level head. And for me, well, all these indicators from SentimenTrader really helped me to get the big picture because the Dow Theory is just a trend following system. The Dow Theory is not going to tell you whether insiders are buying or whether, I don't know, margin debt has reached an extreme or whether there was a breadth thrust. No, the Dow Theory is trend following, pure and simple. And this is why I love it, by the way. But sometimes I want to complement and have an additional perspective. Right now, 10% drop on the S&P, people are panicking, sentiment is in the gutters, very negative. So all these tools, for instance, the TCTM, maybe we can click on it. For me, it's a great, exactly, scroll down. You can see, for instance, well, it's unbelievable because you can see red is when you get, let's say, a sell signal, so out of the market. Green is when it confirms that there is a bullish trend. And look at the right side of the chart, and you'll see that the current pullback has not been enough to shift this indicator to a sell mode, which for me is important. For more, I also look at the different components of this indicator, the recession model, the risk warning model, the composite washout model, etc. So for me, it's important because when people are, you can see that all of them remain in green mode. So for me, it's important because, of course, when there is so much panic out there, getting emails from anxious subscribers is the end of the world. It's for me, it's really important to separate the wheat from the chaff. So maybe we can see the next indicator.
Sure.
Breath thrust. Well, I'm a deep believer in breath thrust. Why? Because there is a proven track record that when you have a significant breadth thrust, the market has a tendency to go up even for the next 12 months, not only for the next 2-3 months. So it is a clear tailwind for the stock market. Is the only element I use? No, I look at the other SentimenTrader indicators. But of course, for me, one of the most important is what state of breath. And furthermore, as you can see here on the website, on their website, you also have the sectors, which is important because, of course, I keep an eye. If a huge bear market is coming, then the sectors should also be displaying one message. So for me, it's another extremely useful tool to put things into perspective. There is another one. Let's go to the indicators.
You want to go to aggregate signal?
Yeah, the aggregate signal. Well, the aggregate signal, well, look, it's great. Just look here. It tends to be another indicator, trend indicator, that tends to be on the right side of the market more often than not. Nobody can say as a trend follower, I'm going to be right all the time. This is impossible. But you can say, furthermore, I must say time frame is important. So my trading time frame is around 1 year. So I'm a trader when I trade the stock market indices, but it's really long term. So as you can see from the TCTM indicator and now from the aggregate signal model, they flash signals more or less in this time frame. So this is not a day trading system or even a swing trader system, which at least for me since when I trade stock indexes, I do it with a very, well, with a 1 year, around 1 year time frame, it's really a great fit to me. So let's go maybe to another one. Well, this is, well, maybe, I don't know, because I love them all, but maybe if I had to take only one, I don't know, because I want to have all of them, but maybe it would be this one. Why? Because the guys at SentimenTrader, they do a very interesting twist. So if you have read books concerning insider buying, selling, okay, they focus, okay, they are, whether they are CEOs, directives, whether, but they give here at SentimenTrader a very interesting twist. And they say, no, look, what we look is at corporate insider velocity. So in other words, what these people do here is that you get the signal, since it is velocity, you don't need a huge level, for instance, of insider buying to get a buy signal. You just need that the velocity, the speed of buying is accelerating. So maybe you can have really very small amount of buying, but in a given, if in a given time frame, this buying is accelerating, you are going to get a signal. And I love this because it tends to trigger, for me, it's a bullish alert. I don't trade on that, but it's very important. So for me, it's a bullish alert that things are going so that I have a tailwind in the stock market. For instance, now, and there was a post a couple, I don't know, 1 week ago or something like that. You penned a great post. And now, for instance, velocity has shifted on the bullish side. So when everybody says the bear market is coming, sentiment is very negative, which is very negative. But what I see is that insiders are stepping up their stock buys. Maybe not in big size, but well, it depends, because in the metals industry, they're really doing big size as well. Velocity and size. So for me, of course, this negates the ultra bearish narrative. So for me, it's really one. Maybe if I had to choose just one, which I wouldn't like to do that, it would be maybe this one. Because you won't find this indicator elsewhere. You will find the normal indicator, yeah, insiders are buying or selling, but velocity, this is a great, and furthermore, you can also get it for sectors. So it's really, for me, it's unbelievable. For instance, I want to check, okay, what's going on with metals or what's going on with financials. So it's an extremely useful tool. So let's go to the next.
Okay.
What we started this presentation saying the probabilities of our market when the Dow Theory triggers a sell signal. Okay, so this is another useful tool I have to know whether there is a looming bear market or whether we have an all clear situation. And okay, so this is for me also important. There's another tool I use because while I think, well, it's not intended for market timing, but when you couple this bear market probability model with a TCMT model or with insider buying velocity, then you get a big picture. This is why I highlighted these 5 SentimenTrader indicators, because it's not just one alone. So then I get a little bit the big picture. And then I say, okay, maybe the bear market probability model is a little bit bearish, but all the other indicators are bullish. And well, these are a little bit my tools because I use my time indicators, but I always want to have my perspective. Furthermore, I am also a stock trader, so not only stock indexes. So I trade for a living, so I trade stocks. So I want to know for my stocks whether there is a tailwind for the stock market or not. So for me, the bear market probability model is also another tool I use. Okay.
That was great, Manuel. And I think, one of the key takeaways that, we try to emphasize to our subscribers almost daily is just, using a weight of the evidence approach
Exactly.
far superior than relying upon just a single, indicator. So we're big proponents of weight of the evidence, and we have numerous composite models that we construct that combine, multiple indicators into one indicator that helps us, assess market trends. So why don't we jump over now, and we'll go to the questions. We've got some, several questions from today. So let's flip over to that. And okay, so first question, silver made a new 4-year high at the end of November 2024, near $35. What happens over the next 6, 12, 18, and 24 months following this signal? And how far back are the historical results? So I created a little, chart and an outlook table, something that we do in every one of our research notes, just to sort of give us a sense of what could potentially happen with silver. Let's go take a look at that. So again, the question was, we made a new 4-year high last year, and what's going to happen on a go forward basis. And interestingly, that was just the latest 4-year high, but prior to that, over the last year, you had made 8 4-year highs. So what I did was this chart on the left is I constructed an indicator, so the number of 4-year highs over the last year. And again, what you can see is that it's totaled up to 8. And what's happened is silver, when it hit that 8th one, it pulled back. But what you notice is once it gets above 8, the annualized returns are really, really juicy. When you have 8 or more 4-year highs over the last year, silver annualizes at 58%. And then it sort of cools off as you get up, to 20-ish. You see that sort of back off, probably normal, consolidation type of action. But once you get to 30 or 40, you can really, really see super high annualized returns, which generally means you are in sort of a bubble up phase when you see those types of annualized returns. If you look at it from just a purely outlook point of view, anytime you've crossed to 8 or higher 4-year highs, which would be on the right, this outlook table, you can see that, 12 months later, you were higher 80% of the time. And, again, so pretty good outlook, but in the short to near term, you're only higher 50% of the time, 2 weeks, 4 weeks, 2 months later. So, you can have it silver consolidate in the near term, to medium term, yet still maintain its uptrend. And so most likely, just looking at this analysis, silver don't rule out a consolidation, but we're most likely in an uptrend, longer term uptrend. Manuel, do you want to add anything here?
Well, I think there is a question that I saw on the chat.
Okay.
So maybe may I answer the question? It came through the chat.
Yeah, sure. This morning, the vesting.com published a Dow Theory flipped from bullish to bearish. Is that the question you're talking about?
Yes.
Okay. Yeah. So it said this morning, vesting.com published Dow Theory flipped from bullish to bearish for the first time since July 2023. What do you think about it? Thank you very much.
Well, I think 2 things. First, this signal comes a little bit late because I told in this presentation that we use our own flavor that integrates the S&P 500 and has a better timing ability. So our sell signal was triggered on March 4th. So already long time ago. So first off is the classical Dow theory. And furthermore, there are many ways to interpret the classical Dow theory. So in this world, everyone claims to be a Dow theory expert. And well, I have my reservations. So first off, our Dow theory interpretation, I insist, with a proven track record, not just an article, triggered the sell signal on March 4th. So there you can see the better timing ability. And secondly, what do I think about it? Okay, first off, I'm going to guide myself by my time indicator because I have no idea what kind of Dow theory these other people use. And furthermore, the one that has more predictive power is ours. So what does it mean, my Dow theory sell signal? Well, as I showed before in one slide, on average, there is a 60% bear market on average. And I stress on average because in each case, anything can happen. On average, there is an 11.22% further decline until the final lows. So, you want to know what I really feel? I think that there can be a retest of the March 13 lows. The final lows were made on March 13, if memory doesn't fail me. And I wouldn't be surprised that there is a small retest that these prices, the March 13 lows, get marginally broken down. But this is just a guess. Why my guess? Because the statistical record says that we could get a little bit more further decline. So this is, but I don't think this time is going to be as catastrophical as dropping 11.22% following the closing price on March 4th, the date of our sell signal. And for all the reasons I said concerning the sentiment trader indicators. So I still, maybe I'm wrong, but I still don't see a bear market. So I still don't see it. But if things change, I will change. We are trend followers. I hope this answers your question.
Okay, let's go back here. All right, so when AA bear, smart dumb money spread, QQ liquidity, and fear ingredients are this oversold along with many other indicators, yet some put call ratios, name, manager exposure measures are neutral or closer to overbought. Does the situation often require more time for a correction low to form, or do you feel a relatively important bottom is occurring now? I've got a chart here just to sort of highlight this question. Again, yeah, we're a little bit out of sync here. This chart was from a few days ago, but as you can see, put call as well as name are still hovering around sort of the midpoint here of their range over the last year. So it's not, they're out of sync, but what I would probably say is that before this is all said and done, everything gets in sync in terms of sentiment being low or pessimistic, and that'll set up probably a more favorable risk reward situation in terms of a bottom and then a thrust off of that. So for right now, we're still in the camp that we've had this relief rally, could carry us up to 5,800, 5,900 on the S&P 500. And then I wouldn't be surprised by some sort of retest of the lows. V-shaped bottoms are pretty rare. At least they used to be rare. With the market, with more intervention from the Fed and fiscal and monetary policy, you've seen these V-shaped bottoms occur here over the last several years, but traditionally markets, you come down, you make a low, you bounce, and then you retest. So next question, let's see here. Well, it's important to know whether the market is an extreme. Should technical trading also involve chart patterns, cycles, and market levels? Manuel, any thoughts here?
Well, if I had to answer, I think I'm going to disappoint because I'm really trend follower. So I don't pay lots of attention to all these things. So this is why the sentiment trader indicators I use are basically those that have a bearing on the future trend of the stock market. So I must confess, I'm totally worthless when it comes to Fibonacci's, things like that. I'm really worthless. And since I'm doing quite well with my theory, I have a second indicator, which is the blind time indicator, which is based on margin debt. which also works extremely well, and furthermore, it provides diversification. But this is the only thing I use outside of the Dow Theory, plus the sentiment trader indicators that help me get the big picture, and notably whether we are in corrections or a bear market is looming. But I think I cannot give a good answer because my toolbox is not that great. I am the Dow Theory, the additional input from Sentiment Trader, and my blind time indicator, which is based on the trend of margin debt, which also works. And furthermore, it complements. So the two of them together in my composite indicator work much better than each piece, each component separately. So maybe Dean can say a little bit more.
Sure. Yeah, I mean, look, if you are, I would say, if you are a short-term trader, then patterns and market levels probably have some meaning. But for people that are medium to long-term traders, this kind of stuff is probably not relevant. I think again, your best bet if you're a long-term investor is just to follow the trend and ignore short-term patterns or market levels. But for short-term traders, sure, this kind of stuff should work, but you need to study it, and you need to understand the probabilities of whether those patterns work or not.
Exactly.
If you're just a discretionary trader and you see a pivot point here or pivot low here, pivot high there, well, how many times does a breakout through that pivot actually work? So it's important. That's what we try to do at SentimenTrader, is to quantify price action. And that outlook table that you saw I showed for silver. I mean, that's what we utilize, in all of our research notes, so that investors our subscribers can get a general sense of, should the market go up, should the market go down, and what's our risk and what's our reward. And that's the key to successful trading, is understanding the probabilities and the risk and the reward. Okay, let's see. All right, so I think that does it for our questions for today. I just want to thank Manuel for being our first ever guest speaker for our new webinar series. Thank you, Manuel, for being here today.
Thanks
I also
for having me on
wanted
your
to.
show.
Yep.
I'm sorry for the sore throat. I'm really with a bad cold, really. So
Yep.
Spanish accent plus a sore throat. So my apologies. Sorry.
Well, yeah. Thank you, and of course, I want to thank all of our attendees today. As you can see on the screen here, we're offering a 15-day free trial and exclusive discount when you subscribe. So we hope that you give us a shot. And we also have a short survey that if you don't mind completing at the end of the webinar, that would be wonderful. If you would do that, that helps us plan for the future, for webinars. So that would be wonderful. And again, Manuel, thank you so much for being here today. And as always, follow the trend.
Follow.
Yeah.
Thanks for having me. Thank you. You're welcome. Thank you.